Zandi is the chief economist at Moody's Analytics. And Mark, it's great to see you again. Welcome, first of all.
Thank you. Thank you.
You're quite zen about the outlook. Utopian. Utopian, I might add.
Zendi.
Zendi. You see gracefully falling inflation next year, a Fed that's able to basically orchestrate a soft landing. I don't know. It just feels like the yield curve and some of these market signals are telling us we could be in for a much harder fall.
Yeah, I think markets are anticipating a recession. That's how you get the Fed funds rate moving south, by the end of next year. I just don't think that's necessary. I mean, assuming stuff doesn't go off the rails here, assuming oil prices don't spike, assuming that whatever happens in China doesn't lock down supply chains again in any meaningful way, I think we can get through the next 12, 18 months without a recession and get inflation back in. The inflation numbers feel pretty good to me. I mean, year-over-year CPI, 7%-ish. Feels like we're headed to about half that by the end of 23 and back close to the Fed's target on CPI. That's probably about 2.5% by mid-2024.
Mark, let me ask you something, because I know housing obviously is a core part of what you specialize in. We are starting to see real weakness in construction employment gains that might be about to tip over into layoffs on net for the first time. And as Steve and I were talking about, I mean, could this be one of the channels through which we start to see the labor market slow? And that is going to tell us the path from here to, any kind of low inflation readings or recession.
Yeah, the labor market is slowing. I mean, you look at the job growth numbers, they are moderating pretty quickly. And my guess is when we get all the revisions to the data, and they're coming, it's going to be revised down. And we're going to see, the job growth did slow meaningfully here. A lot of folks are getting laid off. It's not showing up in the data yet because they're getting severance packages and they have to go through those before they can file for UI and show up in the employment statistics. So I think the labor market is sticking pretty close to a script where it's slowing and the labor market feels like it's easing. The unemployment rate is no longer falling. It's edging north. Employment to population is headed south. So all the things are coming together to make me feel like certainly by this time next year, it kind of sticks to script. We should see wage growth rolling over, and that should allow inflation to come back in.
Steve, before I let you jump in, let's bring in your compatriot. We just had a good 20-year bond auction.
My good friend and colleague from Chicago.
Yes, Rick Santelli is tracking the action. Rick, what do these results tell us?
I'll tell you what, boy, they really lined up for this 20-year. We had $12 billion of reopened 20s, which means really 19-year, 11-month securities. The yield, 3.935, which was about a full basis point below the when issued market. Lower yield, higher price. I gave this auction an A-. And if you look at an intraday of 20-year, you can really see yields dropping at top of the hour. Pretty much every metric was good. The rate was good compared to where it was trading when issued. Bid to cover 2.68, well above 2.58, 10 auction average. Best since April of this year. 8.7 go to dealers. So the buffet table was pretty empty. Dealers didn't get a lot of leftovers. That's always a good sign. And 20 years isn't the longest maturity, but it's a pretty juicy yield. And as you look at that 10-year chart, many believe, the amount of time we're going to spend at lower yields might be over for the rest of the year. So this was a bit of a surprise, but no matter how you slice it, Kelly, Steve, this was a very solid auction as we get ready to wrap up 2022.
Rick, stick around there for just a moment. I just want to have you jump in back here for another comment. Steve, this was significant because the 20-year can typically have kind of soft demand. It's not the market's favorite kind of bond offering. And maybe all of the people who've been lining up to tell us that they like some of the fixed income yields here, maybe this is emblematic. Here they are piling, trying to blow the house down just to get in on this 20-year auction.
I just had an image in my head of people running over Rick to go to the auction.
Right.
Because give me some more of that 20-year paper. It's hard to get in your brain people who want to do that. And I get it because they have maturities that they have to kind of
match.
They have obligations that they have to. But, you're sitting there, you can get a 6-month for 470. But, of course, then you have the risk of rollover. That's
Sure.
going to run out over 6 months. I just want to get back to the inflation story here and ask Mark. Mark, is this two things? Is the 5-month annualized a better way to look at it because you're leaving out some of the stuff that happened a year ago that's not happening right now? And the other question is about whether Powell is too fixated on this services, core services, ex-housing as the reason that's animating his hawkish view right now.
Yeah, Steve, I mean, I think if you want to look at for like turning points in statistics, like the inflation statistics or the employment statistics, you can't just look at the year over year. I mean, the year over year is important, But 3-month annualized growth, 6-month, 5-month. I mean, I think that's very helpful. And you showed it. I mean, inflation is clearly moderating here. So, I think we're moving in the right direction. Still, again, kind of sticking to script. I think Chair Powell is focused on core service inflation because that's the one thing he can have some impact on, right? He can't affect oil prices. He can't affect what's going on in China and supply chains. He can't affect rent growth and the cost of housing services, but he can affect labor markets, wage growth, and ultimately core services. And he's focused on that.